Yeah, so look at the top half of this. The number of share, the top half is the table you've just seen. The unlevered firm and the levered firm. That's the previous slide. Now I'm just showing you the expected operating income is the same. Now, what about the payout to equity holders? This is where I want to get you to understand what the leverage is doing for the firm. So that if you want to begin to move away from a Modigliani Miller world, you're beginning to get an intuition for where you need to look. Now, in this case, I'm not talking about an up market or a down market. We're still talking about the same firm, same income per year. This firm, at the end of the year, they just make the whole payout to the shareholders, okay? So the shareholders get, the payout to the equity holders is 125. They pay all the expected operating income to the equity holders. What do they do to the debt holders? Well, they don't do anything to them because they ain't got any debt holders. They're unlevered. And so the earnings per share is, sometimes people are concerned about earnings per share. And so the earnings per share, I'm just making it clear to you what it is the payout to the equity holders divided by the number of shares outstanding. So the payout to the equity holders is 125,000 and divided by 100,000, 12.5%. Okay, so that's simple. Now look what happens when the firm gets levered. When the firm gets levered, the operating income is the same. But now what they have to do is remember that the bondholders get paid before the equity holders. Isn't that right? So they have to pay the 50,000 because it's 500,000 at 10%. Okay? So they have to pay the interest rate on that. So out of their operating income of 125, 50,000 goes straight to the bondholders. And it's only the remainder that goes to the shareholders, 75. And so now you do the same. So the 75,000 goes to the equity holders. And what's the earnings per share? It's the payout to the equity holders divided by the number of shares. So the payout that they get is 75,000 divided by 50,000. So it's 1.5. So although the payout has gone down, the number of outstanding shares has gone down too, by more, and so that the earnings per share actually goes up. Okay? So that's just that's something you need to be aware of. Simply as a matter of the numbers, in the leveraged firm, you expect the earnings per share to rise. But it's not meaning that the shareholders are any better off because the price has stayed the same.
The 500,000 was used to buy back shares.
Yeah.
So is that not disguising? I know the earnings per share has increased, but the actual shareholders have received money.
Yeah. Yeah, the shareholders have received. Yeah.
It's not really reflected, therefore. Do you know what I mean? It's the earnings per share is based on the.
Okay, that's a fair point.
Okay.
Yeah, that's I see the angle you're coming at. Yeah. Interpreting that.
Finally made it.
John, yeah, no,
Fair
very,
point.
very clever. Very, very clever. You guys are getting far too good at this. I'm going to have to finish these lectures very soon. You begin to show me up. So that's good. And that's really developing the intuition that when all things are considered, they've had their payment, so they're indifferent. But okay, so that's can you see what's happening? There's a very simple unlevered and a levered firm. So what's happened? portion of the operating income now has to go to the bondholders. The shareholders get less, but there's less outstanding shares, so overall the fewer shares, so overall earnings per share has gone up. And the return on shares rises from 12.5 to 15. That's between A and C. Now, really, what Modigliani Miller are saying is the introduction of debt, as you move from the unlevered to the levered firm, it introduces a fixed interest payment and less payment to fewer shareholders. But under their conditions, the value of the firm is not altered. And because they showed the conditions and they derived the conditions under which the share price will not change when this happens. And they're the assumptions I've told you. So you can see the firm's now levered. That's the story I've been telling. Look at point 5. This is really the kernel of the issue. This is the insight. The firm is levered rather than the shareholder. But the shareholder could replicate the firm's leverage by borrowing on their own account in the bank. And if the interest rates that they're facing and the tax rates that they're facing, well, if we put taxes aside, so there's no taxes, and if the interest rates that the shareholders are facing are the same as the firm, they can replicate at exactly the same value, offsetting debt and equity. So there'll be no advantage to any individual shareholder, whatever is the capital structure of the firm. That's the clearest way I can say the Modigliani Miller irrelevance proposition. So I'm now just going to develop it a little bit for your intuition now. There's LTA that we all know and love. That's the one that's unlevered. And LTC is the one that's 50-50 levered. So I'm making a simple point on this one that let's just consider some more examples so you can see what's happening. So LTA and LTC are the two examples we just looked at, where you went from no debt to 50% debt. And so I just want to show you, say, two other, where you go from no debt, so now we'll do Liffey Taxis B, where it's 25% debt and 75% equity. LTC is 50-50, which we've seen, and LTD is 75-25. I'm cutting the pie up, well, I'm cutting it up in four and just look at it, different portions of it. Value of the firm is all the same. There you've got an unlevered firm, 25% levered, 50% levered, and 75% levered. And if you work down, you'll see that the earnings per share rise with the leverage.
So I have a question. Compare with LTA and LTC, A and C, compare with A and C. And in terms of shareholders' point of view, shareholder will get less in case of C, right? But however, earning per share will go up. EPS will go up. So which kind of case is good for shareholder? Amount quantity is less, but percentage will high. So
exactly. So what we're saying, one is offsetting the other, and unless you're getting the value of the firm changing.
If I would like invest company who has A or C, so in terms of investor, which is good to invest.
Yeah. And again, okay. So what I'm saying is, the investor is immaterial between these if the Modigliani-Miller proposition is what's delivering the fact that when the financial structure changes, the value of the firm does not. And so I'm just showing you an example where the capital structure varies significantly, but we're assuming Modigliani-Miller conditions hold so that the valuation of the firm does not change. Even under that situation, the different capital structure means there will be different numbers of shareholders and different proportions of payout to equity. And therefore, it just follows that the earnings per share will change and the returns on share will change. But it doesn't mean that the valuation of the company has changed. So, I hope that answers the question. Some investor might say, well, I prefer that to that. But in a Modigliani world, there's no reason why he or she should. It's kind of, it's a trick of it's an illusion.
So the answer is same.
It's the same.
In this
In
theory.
In this Modigliani-Miller world. So the only reason, the reason we're looking for why capital structure could be important, we have to then generate examples where changing the capital structure would impact on firm value. And Modigliani-Miller won the Nobel Prize for showing the conditions under which it won't. And so you've got to look to tax rates, interest differentials, information asymmetries, and stakeholder effects to see how it might affect.
Does Modigliani assume any fluctuations in operating income? I know that usually goes haywire if it's further leverage, but did they assume no operating income?
They and hundreds of others started off assuming constant, and then subsequent researchers would have looked at how it can change, and then introduce increasingly complex stochastic behavior into it. But I'm going to show you some examples very quickly now. The following slides show you.
Okay.
So in this example, the average income is 125,000 a year for Liffey Valley, Texas. And so really all I'm showing you there is consistent with a Modigliani-Miller world, leverage will increase earnings per share. That's the basic message. So now to Chris' question. Let's now look at what happens if you have a down market. So rather than this, just to set, I'm not going to take so long with this. You'll get the message. The down market is where I'm looking at the same four firms, but now next year it doesn't make 125,000. It only makes 75,000. It has a bad year. And so I'll consider what happens to that down market under the different leverage positions. Unlevered, 25% levered, 25% levered, 50% levered, and 75% levered. How is that affected in a down market? Now the intuition ought to be, and I think this may be what you're getting at, but if the operating income can vary, and if in the unlevered firm, we know that the return to shareholder is more risky because that's the last to be paid. And if you've got no debt, then whatever your operating income is, you just give it to the shareholders. That's it. It's easy. But however, if you're now levered and you have debt, you have to pay back the debt. And you've got to pay back the debt even when you have a bad year. That's the point. That's what leverage means.
You're only paying the interest, you're not paying the capital sum.
You're only paying the interest. Yeah. You've got to pay the interest on this. and you're squeezing out the equity return.
That's right.
Yeah, that's fine. So maybe some years you won't get an equity return, and you see where we're getting. It's getting close to dividend policy now, because maybe you want to give a dividend as well, and then times are getting so tough that maybe you've got to stop. And that's where financial managers will begin to get concerned with leverage with the dividend policy. So anyway, simple point here. Work the numbers, and you can see that with a down market. Oh, just the one we've seen. If it goes, if your operating income declines to 75,000, you've still got to pay the 50,000 back to the bondholders, so the shareholders only get 25,000. Yeah. And if your operating income goes to 75,000, and you are 3/4 leveraged, you've got to pay back the 10% on 750,000 here, which is going to be 75,000 to the bondholders. How much do the equity holders get? There ain't nothing left.
How about an operating profit or operating income of 50,000? How would that affect the equity in this example?
Well, you could actually do that and just work that out yourself. So, an operating income of 50,000.
So obviously I would not have enough money to pay back the debt holders.
Yeah. 50,000. You would be not paying anything to your shareholders, even at 50%. Yeah. So either at a lower level of gearing, the shareholders wouldn't get anything, or else at a given level of gearing, a bigger reduction in operating income is going to have a more serious effect on the shareholders. Okay, and I could draw out 50,000. There will eventually come a time when I won't even be able to pay the bondholders. That's when things are getting serious. That's when the bondholders maybe start retrading the bond and saying this is junk bond. This company is not going to pay back the bond, and the price of our debt is going to go up.
Would that affect then the market value of the equity or price per share in this example? Or if the company would not have enough money to actually pay back the debt holders?
And that's exactly the corporate finance that I'm trying to get you to really, and this is the framework that you're beginning to think about. So the answer is yes. But what we're doing is at the moment, I'm abstracting from the cost of bankruptcy effects, which would be the other approach to capital structure. So the basic point is, you can see earnings per share declining on a down market, the more leveraged you are. That's down market. Now that's intuitive, isn't it? Because you've got to pay the bondholders first. And if you're not earning so much income, you're going to struggle more to pay the bondholders, and you won't have much left over for the shareholders. So earnings per share really goes down. The normal expected market, for completeness, that's the slide we've had about 3 slides ago. Operating income 125,000. And so now to fulfill Chris's desire to look at different market conditions, the up market, let's suppose the operating income goes from 125, goes up 50,000. So if it goes up 50,000, it all gets paid to the shareholders, and their returns go up. Now, even if you're levered by 50/50, you pay back the 50,000, and you still have 125,000 to pay back, which is the same as the unlevered firm in the normal market. So times are good. And so the earnings per share can actually rise substantially. And that's what tends to trick most people when they're talking about a capital structure. they tend to think that as the market is changing, that the leverage will make shareholders much prefer a leveraged firm in up markets, but very much hate a leveraged firm in a down market. And that's what leverage is. Leverage is like you know the lever effect. A stick on a rock and using it to lift another one. So you're using the lever. And so the leverage effect. It's using the debt to be able to get access to more equity. So you're emphasizing the effect of the swings in the business on the effect of the firm. And the Modigliani Miller proposition is saying, that's okay, you don't need to worry about that at the level of the firm, because if the conditions obtain, the individual can do that by borrowing at the bank vis-a-vis the shares and replicate the capital structure in the firm. And so this slide here then is combining all the slides so far. So now across here I've now gone and done the leverage from unleveraged to 25%, 50%, 75%, etc. And I've done it for the normal market, for the down market, and for the up market.
Sorry, it might be a very basic question, but so value of earning per share will be different, depends on expected operating income.
The first part of your question here I get. Make sure I get the right question.
So the number of earning per share is different, depends on expected operated income.
Yeah.
So,
yeah.
So the value of EPS will be different number of operating income.
Yes. Yeah. And that's what the analysts spend a lot of their time doing, is forecasting the expected operating income. So in our example, we've shown you by these examples that the earnings per share could go from 75 cents in a euro up to 4 euros, depending on market conditions and leverage. Now, if you do this on a picture, so all I'm doing now is plotting that previous slide on this picture in a little Excel sheet. So the blue one is Liffey Valley, Liffey taxis. I can't stop thinking Liffey Valley. Why am I going Liffey Valley? Liffey taxis. And so when it's unlevered, then the expected operating income as it goes up, the earnings per share rises. Let's take the 1 here. So as a kind of 50-50 an operating income. So relative to here, if the operating income rises, earnings per share rise along the blue line, 45-degree line. The 45-degree line is the unlevered line. Now the leverage effect is like getting the lever. And so what it's doing is it's taking that 45-degree line and it's shifting it, so that a smaller change in operating income is going to give you a much bigger change in earnings per share. And then if you fill in the others, you can see that all that's happening is that line's going like that. And that's a very good picture of the leverage effect in operation. this slide on capital structure. We'll call it quits at that. But it's food for thought. And then it's time for a break. And the dividend policy I'm going to do in 30 minutes. And then we'll have a course summary. And we'll be finishing early on my last day anyway.